Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Max Cabasso, Managing Director on the Nasdaq Market Intelligence Desk, Michael Normyle, U.S. Economist at Nasdaq, Sandip Bhagat, Chief Investment Officer of Whittier Trust, and Patricia Zobel, Senior Managing Director and Head of Macroeconomic Research and Market Strategy at Guggenheim. We're here to discuss which parts of the economy are proving resilient, which are showing strain, and the growth outlook for 2026. It's great to have everyone with us. Welcome to Trade Talks, and certainly a lot to unpack. We've got the Fed, labor market, consumer, inflation. Let's talk about the Fed first, Patricia. You know, when you think about the policy path and the December meeting, how close do you think that the Fed is to neutral here?
So, you know, I think there's a lot of debate about where the neutral policy rate is for the economy. But what we know is that we're a lot closer to it than we were a year and a half ago. And as we get closer to the neutral policy rate, FOMC participants are becoming more cautious about further rate cuts. They want to see evidence of labor market weakness before they cut further. I think when the minutes came out today, it talked about a real diversity of opinion among policymakers about that. So my sense is, you know, as you see the labor market data come out after the agencies open, you'd start to see that kind of softening that would help support a rate cut in December. I think we got some news today that the November payroll report will be after the FOMC meeting. I think that puts a little more of a question mark around a December rate cut. But overall, I think the path for 2026 is one Fed that's cautiously easing back to 3%. And the thing that's been remarkable to me is that you haven't really seen the overall arc of the policy path change, even as people debate the December rate cut.
Yeah, and Sandip, you know, let's talk about the consumer for a moment here. You know, struggling under the weight of higher tariffs and higher prices and so forth. And we're a consumer-centric economy here in the U.S.
So the consumer is interesting. It is a bifurcated consumer outlook. The low-end consumer is struggling under the weight of tariffs and inflation. And as much as they struggle to spend, it really just simply doesn't affect overall consumer spending, because the sad reality is that there is an uneven share of consumer spending across income categories. So the top 10% of income households make up 50% of consumer spending. And that cohort has not experienced any job losses. They're benefiting from significant wealth effects because they have higher ownership of both stocks and homes. Stock prices, home prices have been high. And so that is almost single-handedly propping up the US economy. You see the same bifurcation with AI spending and CapEx. It's the topics we'll perhaps migrate to. But at many levels, the consumer balance sheets are pristine. The ratio of liabilities to assets has declined significantly. Consumer net worth is at all-time high. And the weakness in the job market, the fact that job growth has slowed down considerably, still hasn't resulted in significantly higher unemployment. We are stuck in that 4.1 to 4.3% range. And the employment to population ratio for prime working age, that cohort, the 25 to 54-year-olds, is rock steady at 80%. People have jobs, therefore they will continue to spend.
All right, and we put these two things, or these three things together. What's the overall, you know, impact on inflation here, Michael?
Well, I think the overall story for the labor market is one of weakness or softness, and so that's why we've seen soft wage growth, and that's a big factor for services inflation overall. And so if you break services inflation mostly into the wage growth piece and the housing inflation piece, the housing inflation piece has been slowing for a few years now. If you look at the rest of services inflation, it's kind of been going sideways, but the wage growth element has been slowing, so you would expect that to kind of reappear in the services inflation number. And the bulk of the weight of inflation of the CPI is in services. So I think that's going to overpower some of the increased goods inflation that we've seen in the next several months, maybe not in the next 1, 2, 3 months, but beyond that kind of reappear and put some downward drag on overall inflation, which should make it easier for the Fed to worry about the labor market. I kind of feel like Fed Governor Waller is the voice of reason here, while everyone else is suddenly incredibly hawkish, but that's my personal opinion.
Yeah. Well, and Max, back to the consumer for a moment. You and I were looking at data from Kashish this week, and lends to what Sandip was saying about the segment of the consumer population that if you take a look at prepaid card usage, BNPL, DIY spending, doubling luxury.
Yeah, it's definitely a bifurcation. We're talking mandatory spend has gone up to almost 73% of total spend. Fast food, even dining, has gone down. DIY has gone up now. It's now 2x luxury spend. BNPL, 6 loans per month per person using them. And the one that really stuck out to me, 300% spike in rewards redemption for micro purchases, and rent and medical bills being split between multiple payments. So that is a sign to me of people, again, in that lower end of the scale, really struggling, really starting to hurt, and trying to find ways to make ends meet. And again, trading down, fast food numbers down, DIY up, cooking at home, really looking for ways to pinch pennies. And again, we always talk about the market is not the economy. It's not even the market is not the economy. It's the market is so different than that lower half, that in that K-shaped, kind of recovery we talk about. There really is that bifurcation, and we get a bit lost in focusing on the market, even after we had, kind of this rollover a bit. We're still only a few percentage points away from all-time highs. Valuations are still elevated. You're starting to see cracks there, but we're still, again, we haven't crashed. The market is still holding up relatively well. Rates are now, 10 years sitting around 4%, a little higher, 10 basis points higher, but that's not moving a ton. Volatility's been relatively quiet, but again, underneath the hood, similar to the market, and the mega caps really holding everything up. Small caps continue to come under pressure. That lower quartile of consumers, they're under additional pressure. As we're seeing, the others, the haves essentially continue to the wealth effects to really that flywheel take effect. So you're really seeing a split, and that hasn't really been closing like you would hope. Similar to the market, mega caps versus small caps, you kind of hope for that consolidation and that trade to close that gap. You're not seeing it really in the market. You're not seeing it in the economy as well.
Yeah. Let's go back to the AI spend for a moment here, Patricia. How is this massive AI capex cycle? How's it reshaping how corporates are thinking about issuance, how they're accessing the credit markets, and so forth?
Well, so I think what's notable so far is that the level of capex that's happened for AI to date has been growing, but it's not large relative to prior tech transitions. But what you're going to see is that accelerate over coming years, and that's what investors are really questioning. They're wanting to see companies that have discipline in their approach, that have ways to monetize these investments, and I think that's part of why you've seen equities downdraft. In terms of what this means for credit, you have companies that have been relying on free cash flow. They're going to be borrowing more in coming years. That's going to span fixed income products from private credit to asset-backed securities and investment grade. And so you're going to see an absorption of a lot of new supply, and you've already seen that widen spreads out a little bit as they're digesting new issuance. So I think what investors are looking for, they're going to be looking for discipline, and as long as fundamentals stay strong, it shouldn't widen spreads too much.
Yeah, well, think about AI has essentially propped up the U.S. economy in 2025. Is that, what happens if that spending doesn't increase, or was it too excessive at this point?
So the narrow base of this economic platform, or even the launch pad for growth in 2026, is troubling to many people. Everything else is stagnant and sluggish. But I think we are at an inflection point where perhaps that base is going to broaden, because I can look out and I can just see there are 2 or 3 different drivers of the US economy next year. We know fiscal stimulus is in the pipeline and kind of gushing towards us. It's going to be just shy of $300 billion. The Fed has resumed its easing cycle, so we have lower interest rates to provide monetary stimulus. Deregulation might come through. The administration began with the global trade war. Tariffs are restrictive. They wanted government job cuts. Those are restrictive. Those were events of 2025. They were headwinds. They are about to dissipate. And Patricia, you are right, because AI is not quite close to bubble territories we have seen with prior episodes of excessive spending. So right now, I think all said and done, there'll be about 400 billion of spending on AI in 2025, projected to go up. But the 400 billion today in a 31 trillion economy is just a little over 1% of GDP. And in prior bubbles, in .com, that number was in excess of 4%. For the housing bubble, it was close to 4%. If you go back to the railroads, it was over 4.5%. So as bubbles go, we're not quite at nosebleed levels. And again, these companies that are doing the spending have the luxury of significant operating cash flow because they're hugely profitable.
Yeah, I mean, Max, you could also make the argument too that perhaps these valuations are not that excessive. Maybe these companies can grow into their multiples.
Yeah, it's really possible. Like you were talking about, though, it's that discipline, and is it building for hope of future demand, or you have the current demand now to then go out and build? But it's I truly believe there's going to be winners in the space, and there's going to be losers. This is not. I don't believe at this junction it's going to be the rising tide lifts all boats. There's going to be those that are successful, that have the balance sheet, that don't have to tap debt markets, even though we're seeing some tap additionally. But you're talking about credit spreads starting to widen out. You've seen investors take a closer look. We had Oracle news months ago, popped $300 billion. It's since given that all back. Spreads have widened out. We've seen that with a number of other companies. So the growth there is real, the spend is real, but it's now, at what point do investors really start to focus on, okay, how are we going to monetize this? How are we going to turn a profit on it, and not just focus on the revenues? Because the revenue growth is great. At some point, you have to turn a profit on it, because these numbers that we're talking about are substantial in the grand scheme. Now, again, not as a percent of GDP, but just in the grand scheme of funds that are out there. You're seeing some cracks in private credit that are really in the AI data center build out. So again, I think there's just more questions on it, and I don't think that's necessarily a bad thing to not just allow reckless spending. Investors saying, wait a second, if you're putting my money to work, that the company has, and now you're tapping debt markets, what are we going to get back from this, and at what point? So maybe you can grow into the multiple, but at what point? Is that a short-term thing, or is this 5-10 years out? And that's where we might get a little of those blips on in the months and years ahead. It's just, how quickly is this going to really be monetized, and is it more hype in the short term? Not so much the long term, but the short term, is this going to turn into something real that companies can now show on their balance sheet that, hey, this investment is going to turn around, and it's not going to be 10 years down the road.
Yeah.
And can I say, oh, go ahead.
Oh, so sorry.
And can I say just that, this issue isn't one of, is it going to be 5 or 10 years? These assets are going to depreciate fairly quickly because the technology will change. And so the question is, can you develop revenue and profits in the appropriate time frame for this type of technology investment?
Absolutely.
Yeah.
That was precisely the point. It is really a matter of 3, 4, or 5 years, because these are depreciating assets on which so much money is being spent. So where is the ROI, and more importantly, how soon will these pay back before they become useless and obsolete?
Or at least in the short term, but at least you have the build out, the actual infrastructure that has been talked about on earnings calls, that process of getting everything built out, and always go back to energy, how we're going to power this, and how does that impact consumers as well? If you see your energy prices going up, is there a data center that's close by that's causing that? The trade-offs between consumers and corporations building these out. Once the infrastructure is there, I think those questions get answered, but in the short term, it's that process is absolutely costly, so you do have to start recoup some capital on that.
But even still, once this infrastructure is built out, NVIDIA, who's reporting after the close today, its CEO said that the AI chips are going to go from 2-year cycles to annual replacement cycles. So that that's going to change the calculus for capex spend for companies as well. Not everybody has pristine balance sheets and that operating leverage. So
right, and do you need to refresh every year? Can useful life, is that actually 8 years, but you depreciate it on a 5-6 year schedule? There's a lot of questions that still have to be answered. I've seen a lot of reports that TPUs actually are still very useful. They're a lot cheaper. So there's a lot of questions that are still coming, and I think that's what investors are starting to focus on, is what are the alternatives here? Are we the only ones really pressing this far ahead, this aggressively? Do we need to be doing that? So those are just the questions, I think, in a healthy environment, are the questions that get asked to to these companies that are outspending. It's, okay, show us the outlook for the next 5 years. Are we changing these out every year? Can you make money off these? How profitable will each chipset be?
Yeah. Well, I mean, Michael, it makes you wonder if you're not sure what your replacement cycles are going to look like or what types of jobs you need going forward. Perhaps that's why the unemployment rate is remaining stagnant, wage growth is remaining stagnant, because just trying to understand how these technologies are going to be applied.
Yeah, I mean, uncertainty has really been a buzzword for 2025, I think, and that's a big factor for companies where they're just not sure where they want to hire or how they're going to roll out AI, where it's going to affect them. So, there's been a lot of surveys lately about how businesses are using AI. Adoption rates are still relatively low, so you don't see a lot of companies saying, I'm laying people off because of AI so much, but they do say maybe in 3 years and 5 years that's going to be a factor, but the way I'll get there isn't so much layoffs, but more attrition and hiring freezes and things like that. So we'll see.
Jill, there is a very important tailwind here that diffuses a lot of this concern. And I think I'll put that on the table, which is that we're just coming off a very strong earnings season. How strong? Earnings growth year over year was projected to be 8% for the third quarter. We clocked in at 13%. Now this double-digit earnings growth is very rare. We have now posted 4 consecutive quarters of double-digit earnings growth year over year. The last time it happened was when earnings had been decimated in the pandemic in 21. They rebounded with a vengeance. 4 of the next 5 quarters are also projecting double-digit earnings growth. Next year is 14%. The year after that is 12%. And when you have so we are now in the earnings-driven phase of the bull market. We started with stimulus, creates a flood of liquidity. Liquidity-driven bull markets see multiple expansion, prices go up in the hope that earnings come through. Now they are coming through, and in a big way. And this is the most reliable part of the bull market, and we are in the middle of it right now. This is what we are going to take into 2026.
Yeah, and that's a great point. So Max and I were talking about before, where perhaps these multiples are justified and their companies are going to grow into them because of earnings, not because of liquidity.
And I think for me, for third quarter, what was notable is that it wasn't just the tech companies that outperformed expectations. It was pretty broad-based across industries. And so we also noted third quarter earnings as being an important positive right now. I think for me, though, for the multiples and the valuations of the tech companies, I think there's good differentiation across them, but you have to ask yourself, are they taking into account the full range of possibilities as we travel down this bumpy path to AI adoption? What if models become more efficient? What if models become commoditized? What if we have power constraints? These are all things that could be disruptors. And so when I look at the valuations, I don't think of them as necessarily in bubble territory, but I ask myself, are they taking into account all the possible ways that we move toward an AI-driven economy?
Yeah, I mean, the energy part of that equation is key, right? I mean, you can't execute on these projects if there's no power to make them run. Yeah, that's a good point that you brought up. All right, appreciate everyone's insight. Thanks for joining us on Trade Talks. And thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.